The CPA and Associates, accounting done great by mates.
Hi there, I'm Daniel Lader, founder of Lader CPA and Associates, and welcome back to our ongoing series, Tax Strategy, right here, right now, where we are talking about great ways to reduce your tax bill and skipping all the jargon. So, this week, our topic is going to be on retirement plan selection. Now, if that sounds like a confusing topic, it is. That's why we're covering it in this video, to kind of simplify things a little bit. Now, if you are a private practice owner, retirement plans are one of the cleanest two-bird strategy. You know the old adage, two birds with one stone. So retirement plans do this. They build wealth for future you, and they lower your taxable income for current you. Those are the two things they do. So the goal today is by the end, we will talk about, and you will hopefully know which plan best fits your situation based on a few questions. Do you have employees? How steady is your profit? How much paperwork can you tolerate? And how much do you want to contribute each year? So let's start by defining a couple terms. I want to talk about the three most common retirement plans for a small business. The SEP IRA, sometimes called the SEP IRA. This is an employer-only contribution plan. The Simple IRA. This is an employee and employer contribution plan. And the Solo 401k. This is a single participant, meaning the owner only contribution plan for both the owner and the business. That's the most complicated. We'll talk about all three and how they differ and how they're similar. Now, first, we need to start with the employee question. Do you have employees in your practice? Now, if you have employees and not contractors, we're not talking about contractors. If you have employees, then the Solo 401k is out. You cannot use it. You can choose between the SEP and the Simple IRA, unless you're already large enough that a full 401k plan makes sense. And if that's the case, well, you would already know that. Now, if you have no employees, then the Solo 401k or the SEP can make sense. So let's talk a little bit about the different options. First, let's start with the SEP IRA. That's the simplest. It's flexible, and it gives the same percentage for everyone. We'll talk more about that. An SEP IRA, it's best if you are a solo practice owner or you have a small team and you want the maximum flexibility year to year on how much gets contributed to retirement. This is an easy plan to set up and easy to administer. Now, if your profit goes up and down and is not steady, then this plan works great for you. So how do contributions work? First, with the SEP IRA, only the employer, meaning the business, is making contributions. The employees do not defer anything from their paychecks. Now, you can choose how much to contribute each year. It could be 0% in one year. It could be 2% in another year. It could be 15% in another year. It's up to you, and it depends on how much your business can handle. But, and this is important, when you do contribute to an SEP, your qualifying and eligible employees must receive the same percentage of pay that everyone else gets. Remember that. That's a trap some people fall into. So the big advantages of an SEP IRA is it's so flexible, and you can even skip a year if it's a bad year. It's a lot less administrative work, and you can set it up very late and still make full contributions. So I like to recommend that if you have an SEP IRA, or if you want an SEP IRA to apply to last year, it might not be too late to set up an SEP now and have it apply to last year and make contributions for last year. So keep that in mind. It is very flexible. Now, some common problems that I run into. First, you have to remember all of the eligible employees must get the same percentage contribution. You can't give yourself as the owner a big contribution and forget about your employees unless they're not eligible yet. The second problem is you can contribute late, but you cannot contribute late if you have not filed an extension for your taxes or you file your business tax return too early. That'll throw a big wrench in it. We're not going to go into details on that, but be aware and talk with your tax professional about when to make an SEP IRA contribution. The second type of plan we're talking about is the simple IRA. Now, this plan is great for small teams when you have a very predictable cost and income each year, and if you choose a lower contribution amount from the business. So these are for group practices with a W-2 staff, and you want a very simple, straightforward plan. You also want your employees to contribute to their own retirement through payroll withholdings. And you can commit a certain amount of employer earnings to this contribution. Now, how do the contributions work? In this one, it's a little bit different, but also it will be a little familiar. The employees can contribute from their own pay up to a certain annual limit, which we'll get to later, but they can contribute out of their own paychecks. The employer has two options on how to make contributions. The first and more common is the employer matches participating employees' contribution up to 3% of their pay. That's a fixed 3%. The second option is the company can contribute 2% to all employees, whether they're participating or not, 2% of their pay. So those are the options. Business contributes 3% to employees who are participating or 2% to all employees, whether they're participating or not. Now, there's some great advantages for setting up a simple IRA. First, it's pretty easy to set up and it's a lot cheaper than running a full 401k. The employees also like it because they can contribute too. There's a couple mistakes we have to avoid. First, be aware that there is a setup time for the simple IRA, and it's very strict. It's actually October 31st of the year you want the simple plan to start. You don't get those last 2 months of the year. It has to be set up during the year by October 31st. You have to comply with the employee's election window. Be aware of that. There's more rules here. Early withdrawals from a simple IRA plan can have additional penalties. Be aware of that. Now, the third retirement plan, and my favorite, because of how much it can be used for, is the solo 401k. Now, this is best for contributing the maximum amount of retirement contributions for the owner. How this solo 401k works is the owner now wears two hats. They are the employee and they are the employer. They contribute their own employee deferrals out of their own paycheck, and the business makes a match to that 401k for them. Now, the total contributions to a solo 401k are capped, and we'll get to those limitations later, but the total amount you can contribute into a solo 401k is much higher on a smaller salary than it is for other options. So keep that in mind. If you want to maximize retirement, solo 401k, that's the direction. Now, there's a couple trade-offs to be aware of. First off, with a solo 401k, there is more setup and more upkeep than the simple or the SEP IRA. Now, once the plan's assets get big enough, it could be possible you'll be forced to act more like a traditional 401k, meaning more filings, more paperwork. The last is if you do hire employees and they're eligible, the advantage of a solo 401k just goes away and you have to follow the regular 401k rules, which is probably what you were trying to avoid with these simpler plans. Now, I'm not going to go through the numbers. If you want to pause the video right here, the numbers will be there. The limitations and the contribution amounts for 401ks and simple IRAs. Now, deciding on a retirement plan, it can be pretty simple once you're aware of how they all work. There's 3 simple rules you can follow. If you have a team and you want a low hassle plan, use a simple IRA. If you want flexibility and might contribute big in some years and zero in others, an SEP IRA. And if it's just me and I want to max out retirement savings, it's a solo 401k. Now, I have some practical tips for you practice owners. to remember as you're choosing a plan and thinking about it. First, know your 12-month hiring plan. If you plan to hire more W-2 staff, don't pick a plan that you're going to outgrow in 6 months. Next, decide what you're going to optimize for. Are you looking for the lowest admin, or the highest possible contribution, or the most predictable employer cost? All of those would mean a different plan. Put the retirement plan decision and contribution date on your calendar. Remember, the SEP IRA, it is the most flexible when it comes to time, whereas the simple is the most restrictive when it comes to timing. Also, don't mix up your contractors and your employees. A 1099 contractor does not get to participate in your retirement plan. And remember not to misclassify your contractors and your employees. That's a real risk. Make sure you're doing it right. You do not want to find out a contractor should have been an employee this whole time, and now you're facing consequences for not including that person on the retirement plan. So a couple closing thoughts. The best plan is not the one with the biggest limits. It's the one you'll actually fund consistently and that still fits you when your practice has grown. So a question I want you to think about: if your practice doubles in the next 18 months, which plan will still work? And which one would force an expensive switch? Next week, we're going to take a deep dive into solo 401k contributions for the employee and the employer buckets. So tune in. Don't forget to like, follow, and subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend. Keep helping others to help themselves, and let us help you to do just that. I'll see you next time. Bye.